So that suggests that markets may remain volatile, especially during the lead up to any upcoming tariff announcement. So I think headlines is that he has actually floated 1st February as the date where tariff could come into play for Canada, Mexico, and China. And of course, he also mentioned EU is in his crosshair as well, but he didn't specifically mention any form of tariff rate for EU. So currently, he has floated 25% on Canada, Mexico, 10% on China, which I believe this 10% on China could just be the first stage. There definitely room for it to be increased further. We could be looking at potentially a 25, similar to Canada and Mexico. So that's my view, but we will have to see how it goes. But as of now, my advice during this period of Trump presidency is that yes, there will be volatility based on whatever he tweeted or whatever he said during a press conference. But it's also important for us to look beyond the short term, all of this political noise. Given that ultimately we still look towards several key macro fundamentals to drive our stock market performance, such as economic conditions, alongside corporate earnings. So later I will show some example of how corporate earnings is actually that is the medium term driver for a stock market performance. But as of now, I think interesting times. Let's hear definitely what Trump has to say over the coming weeks. So just to note, today's webinar is purely for educational purposes only. It doesn't constitute any form of investment advice. So please do your own due diligence in terms of your own investment or trading. Okay, so key thing here will be the Telegram group. So if you are interested in using Telegram to keep track of some of the market news, you can follow IG Asia. All our analyst piece will be posted on this Telegram group. So it's very convenient for you to keep track on some of our content. Okay, so like I mentioned, if I were to give a name to today's webinar, I think it will be Welcome to the Trump 2.0 era. So first day, today is the second day actually. First 2 days, I think we have heard quite a bit on what Trump has to say. I think the general focus here is that there is this sweeping crackdown on immigration. So over the next few weeks, we should get a lot of deportation efforts of immigrants. Trump is also U-turning all of those clean energy climate policies that was being enacted during the Biden era. So all of these are being, sort of reversed. He is a fan of sort of dirty energy. So his famous quote is, drill baby drill, meaning he's gonna aggressively increase oil production. So he actually declared an energy emergency for the country, which means that we should expect some form of a higher production moving forward. But of course, the key here is that for you to ramp up energy production, it will still take time. So it will take some time for oil supply to be more significantly felt in the markets. So until then, later I'll show you the oil prices chart. Until then, we may still expect, oil prices to see potentially some form of a support moving forward. So other than that, I think key points is around TikTok. A lot of debate over what comes for TikTok next. He's open to Elon Musk potentially buying it. Trump has floated this 50-50 partnership, meaning 50% goes to ByteDance, 50% should be owned by a US corporate. So let's see how it goes. And more importantly, I think he also mentioned this private sector investment overnight of up to $500 billion to fund AI investment, AI infrastructure over the next 5 years. So that explains that jump in the share price for Oracle. And we should expect some form of a follow through in terms of this tech stock itself. So these are some of the key takeaways that I've listed under this table. I think the main point I just mentioned earlier. The other more important one, mainly the tariff threats that he have mentioned. Apart from that, is a lot of focus on immigration, a lot of withdrawing of international bodies, such as the Paris Climate Agreement, the World Health Organization. So this is what we get from Trump first 2 days. We'll definitely keep a lookout for what's up ahead. Especially, market will have its focus around tariffs. So until then, we may expect slightly this tone of caution around some of the Asian equities, given that, back in 2018, when US has that trade war with China, we actually seen exports across the region slow down. So, any form of a trade restriction will have an impact on Singapore, will have an impact on the region. Our economy is kind of sensitive, very sensitive to exports. We are kind of reliant on it for growth. So any form of pressure there, that could directly impact our economy. So definitely something to keep a lookout there. And till then, till we get that concrete action on that trade measures, I think generally a tone of a caution should persist, especially as we lead up to the 1st February timeline that he has actually put out there. But now I just want to shift your focus towards that strong AI infrastructure investment, private sector investment that he has put out. And this chart is really just to show that US has already been ahead, kind of far ahead from its global peers in terms of data center. US accounts for almost half of global data centers. So as a tech company with that Trump presidency, I think the first thought will, of course, to set up shop in USA. So I think that could continue to drive that form of innovation and that pull ahead in terms of technology competitiveness. So I think we shouldn't kind of shrug off the growth sectors this year, despite a lot of talks that valuation is high. For sure, yes, valuation is high, but if we factor in that growth, that earnings growth that is being delivered by that sector, that valuation seems more reasonable. So I think it's not, it will still be reasonable to have some form of exposure towards some of the tech sector and also to the Magnificent Seven stocks itself. So some of the sectors that we are watching, today I'll share with you 3 sectors which we believe has a potential to drive higher in 2025. One of it is utility sectors. So the rationale is that over the past 1 to 2 weeks, we are actually seeing utility sectors gaining more traction, with this lead up to the Trump presidency. It has kind of outperformed the broader index over the past week. And our view is that, with that ramp up in AI demand, it will require a lot of computing power. And as such, we believe that utilities, that energy demand should continue to be this tailwind for the utility sectors. And if you look on the broader portfolio kind of perspective, we believe that, of course, we should have some form of exposure in our portfolio towards our less volatile, some form of a defensive appeal, which we believe the utility sectors kind of bring that. So having that in a portfolio, it does potentially bring down volatility, and also having that exposure to the AI theme in terms of energy demand. So we think there could be more room to grow for utilities. Of course, the risk factors when we talk about utilities is that it is heavily reliant on debt. When we talk about utilities, it means we require very huge infrastructure, right, to deliver that form of a energy supply. And that huge infrastructure will require, some debt outlay, means you got to take on debt, which will be directly related to the Fed's interest rate outlook. But in our sense, we may argue that markets have sort of priced in kind of a hawkish Fed already. Markets are looking for just one rate cut through 2025. the worst in our base case is that we could be looking at no rate cuts. But in terms of rate hikes, we still think that it's still off the table for now. So we believe that much could have been priced around the Fed's rate outlook. So therefore, that pressure on utility sectors on a more hawkish Fed is kind of limited in our view. And if you look at the chart itself, a very nice uptrend that we are seeing here, that brought the rising channel pattern. Previously, just last week, it has kind of retested that upward trend line. You can see that it bounced off quite nicely around that support confluence, around that 200-day moving average. Momentum is building. Therefore, we believe that there could be room for more upside in terms of the utility sectors. So a hawkish Fed, yes, probably priced to a large degree in our view. Markets only expecting one rate cuts. And this chart is the utility sectors, the XLU, relative to the broader index, which is the S&P 500. So since September 2023, you can see that utilities have really been underperforming the S&P 500. But recently, it does seem that sentiment seems to be turning. We are seeing some form of a stabilizing or even this ratio kind of increasing, which means that utilities is starting to sort of outperform the broader index once more. So definitely something to keep a lookout for. The next sector we have in our mind is financials. So we do have a lot of US banks earnings over the past week. So far, things have really been quite promising for the major US banks. Top and bottom line, beat expectations by a far margin. There isn't much to really find fault if you were to keep track at US banks earnings, right? It really seems that things are very rosy on all fronts. If you look at the guidance, if you look at their outlook on the economy, they have actually pared back on their loan loss provision, which means that they see that the economy holding up. Top and bottom line beat as well. If you look at some of the key tailwind through 2025, number one is the hawkish Fed. If interest rate cuts were to take place at a slower pace, what this means is that the bank's net interest margin could also be slow to taper. That is in their favor. And we are also seeing a sort of a recovery in the capital market activities, M&A. Those could support growth in their investment banking fees. US economic resilience should continue, given that strong retail sales number, that strong jobs report that we got last month. It really suggests that we could be looking at some of a reflation in the US economy. So that could help to underpin the bank's loan demand. That could limit some of their allocation for a loan loss provision, which should help earnings. And with that Trump administration, I think an added boost could be any form of a deregulation efforts. We haven't heard much about deregulation around the financial sector just yet, but I think deregulation does seem to be something that Trump is going for. So any added form of a deregulation in the financial sectors, we believe that will offer the added tailwind for the financial sector itself. So likewise, based on the technicals, this is the XLF ETF, which is the US financial sectors ETF. It does seem that the trend remains to the upside. Momentum has been improving based on the RSI numbers, based on that higher high and higher low trend that we are seeing on the chart. On the relative scale to the S&P 500, it has also been improving. So it has sort of, you can say it has broken out of that previous consolidation, the range that has been present through 2024, since May to September. Now we are seeing greater traction for their financials with that outperformance for the sectors relative to the S&P 500. So we believe that it could continue to outperform, the range we are seeing could be that that previous peak back in 2022 or even 2023 itself. Okay, the last sectors that we have on our mind is communication services. The rationale for it is when we look at the earnings projection for the upcoming quarter, based on this fact set data, it suggests that communication services earnings growth is the second highest behind financials. So I mean, that could be one of the added catalysts for the financial sector's earnings growth. Communication services stand second, and looking at that 21% earnings growth rate, we think that it is stellar and should support or rather provide some of the justification for its valuation that it currently draws. And when we talk about communication services, I think no doubt, it will be very sensitive to two stocks. One is Alphabet, one is Meta. Both carry significant weightage in the communication services sector. And just plotting it across some of the mega cap tech stocks, such as Amazon, Microsoft, even Netflix, Apple, Nvidia, Tesla. Looking at the valuation, Alphabet and Meta thus seems to be the relatively cheaper ones across the other mega cap tech counters, given their current earnings projection. So what this means is that as long as they are able to deliver to what their current earnings projection, markets may sort of be more willing to attribute some form of a higher valuation for these two counters, which has that potential to drive up the communication services sector itself. So Alphabet, Meta, definitely something to watch there. On the chart for the communication services, sort of an upward trend. Near term, there's some form of a retracement, but it does seem that things are reversing to the upside, which we believe, further upside could confirm this bullish flag. And if you are a technical person, bullish flag is generally a continuation pattern. So it means that after a near-term retracement, the upward trend should continue. So these are the three sectors that we are keeping an eye for through 2025. But of course, on the broader index kind of perspective, if you look at the S&P 500, it is currently less than 1% away from a new all-time high. Our view is that a new all-time high is much achievable. Technicals does suggest that buyers' interests are strong. We are seeing a continuation of these upward bias. And the good thing is that if you look at investor sentiments, so even when we have the S&P 500 just 1% away from the all-time high, if you look at investor sentiments are still leaning on the bearish end. So what this means is that there are room for improvement for many of those investor sentiments if they were to switch, from being bearish back to being more bullish. So some of the indicators we can look out for to gauge sentiments, I think the more popular ones, the fear and greed index. Previously, it was slightly nearing extreme fear, but now, we are still in fear territory, despite that up move in the S&P 500. Or even when we look at the US bull-bear spread, it has previously dipped quite significantly. And based on statistics, when it dipped kind of more than 12% to the downside, generally it marked a near-term market low. So based on this, we believe that sentiments are not too overblown, not too extremely bullish, such that it hinders any form of a upside. We believe that there's still room for bearish sentiments to sort of unwind, which will mean that there could be some form of an upside tailwind for the broader index, for the S&P 500. So we thus believe that we may achieve, a new record high moving forward over the coming months itself. Okay, now let's take a look at the Nasdaq. Likewise, previously you can see there was it should be a descending triangle. So ignore that typo. It should be a descending triangle. Previously there was lower highs. Now buyers are trying to overturn that lower highs scenario. We are looking at a move to a new high, in today's session. Overall, nothing to really find fault with, I believe, based on the technical side, that upward channel in place, trends pointing to the upside. Momentum has also sort of shifting based on that bullish MACD crossover. Okay, one thing that we believe could also see a greater upside, potentially even more than the other major indices, is the small caps. We believe with Trump coming in, that deregulation theme generally should favor the small caps to a greater degree. And of course, small caps have been that laggards over the past year. Over the past year, we know that stock market performance have been heavily lifted by the Magnificent Seven stocks. So there are room for some form of a catch-up growth. And based on the technicals itself, it does seem that, that broad rising channel, that upward trend also remains in place. Near-term bullish divergence on MACD, all of those technicals seems to point to the bullish end. And one thing that I'm looking at is the weekly chart for the Russell 2000, the small caps. I think I'm taking particular notice on that 50-week moving average. On the longer term chart, I think some of the indication we can see is, or even the buying point, the levels to buy. I think the 50-week moving average does give us that kind of conviction. It has sort of supported prices for the third time now. Most recently, we are seeing some form of a bullish reaction around that 50-week moving average. The second thing we can keep a lookout for is the daily RSI. The weekly RSI. This is the weekly chart. The weekly RSI, whenever, currently is trading above that midline which is the 50 level. Every time it reverts to that 50 level, to keep that upward trend going, we see that there was somewhat of a bounce off that midline, that 50 level. Recently, it has reverted back to the upside again. So I think in the form of any retracement, two things I'm watching: the 50-week moving average. Second is the midline for the weekly RSI. I want to see both. When prices fall back, I'm willing to sort of buy into it. Given my view that the upward trend should continue, I believe the risk reward should also be attractive around these indicators as well. Okay, so now let's move away from equities. We can take a look at the commodity space, which has also been gaining kind of a traction over the past weeks. One is oil prices. So investors are really wondering, with Trump 2.0, he wants to drill, he wants to have more US energy production. He wants to have more oil supplies into the market. On the other hand, he also mentioned that he's open to have more sanctions on, on Iran, more sanctions on Russia. So how does that net effect kind of plays out with all of these conflicting drivers in place for the oil market? I think it's definitely hard to quantify what is the net effect given all of these market dynamics. I think the near-term focus, of course, he has laid out his aim to fill up the US strategic reserve. Looking at that chart, you can see that the current state of US strategic reserve is still very low. It is still at its 1980s kind of a level. So to fill it up, definitely there are a lot of room to go. How we perceive this is that we believe this gives a near-term floor for oil prices at around $70. And what this means is that if in that scenario where oil prices were to dip back towards that $70 level, we are happy to jump in with a buy. And the rationale is that recently, over the past month, we have seen this uptick in terms of the US Treasury Reserve, which means they are building up, which means they are buying, from the market to fill up their reserve. And just putting this together with that oil chart itself, it does seem that there's a strong buying activities around that $70 level. So I think this indicates that we may expect some form of a floor for oil prices at $70 in terms of Brent crude. Of course, other focus will be the tariff policies. A lot of question on how much of the tariff will actually be passed on. That will have implication on the global growth. The higher number it is, that means there could be more economic pressures on many of the countries which are exporting to US, such as China, and that could also weigh on the oil demand outlook. So it's the dynamics is conflicting for sure, which is why we are seeing somewhat of not much of a I would say we are still seeing this tone of caution around oil prices recently. Based on the chart, there's some form of a pullback from its recent high, some cooling off in terms of oil prices. But of course, with that near-term shift in the sentiments, previously it has broken to its multi-month high. We will still be looking for this shift in sentiments towards the bullish end to continue. What this means is that we are looking for any formation of a new higher low to continue this near-term upward trend. One of the range that we are looking at could be around the $77 to $78 level. We are happy to see any form of a consolidation there before another leg higher. Okay, the other commodities, a lot of traction is gold. Recently broke out of this range, so I think that is quite significant. That $2,723 level. So prices previously, whenever it interacts this level, there was a strong sell-off. There was that long bearish candlesticks being displayed. But now we actually moved past, we actually edged above, which means buyers have managed to overcome all of those supply resistance at this level. That should pave the way for further upside. So I actually talk about gold in my market to watch report this Monday. I gave it, an upside call, and just based on that, I call it the third time's the charm. So when you test a resistance, first time fail, second time fail, generally the probability for the third time is leaning towards a breakdown. Of course, we got to see some form of a consolidation around resistance. So consolidation around resistance just means that selling pressure is being absorbed. I like to see that it means that buyers are stepping in, because generally at resistance level, we should expect a lot of selling pressure. But if you are seeing price kind of consolidating there, which means, selling pressures are being absorbed, it means that buyers are ready for a breakdown. So I think that's what present in gold prices. Some of the catalysts, the fundamental catalysts, of course, US dollar weakness, gold offering this hedge against Trump 2.0 geopolitical uncertainties. And last but not least, if you look at some of the gold ETF holdings, I believe that investors are not fully buying into it yet. So what this means is that there could be room for catch-up investors' demand. And this is what I mean. Generally, when when gold ETF holdings increase, gold prices increase. But now what we are seeing is that gold prices have ramped up quite strongly, but ETF holdings are still relatively muted. Some of the reasons could be because that ramp up in gold prices is due to central bank demand, it's due to institutional or investors. So in our case, we believe that there could be some form of a room for more investors' interest in gold to improve over the coming months. That could offer some form of a buying strength for gold prices moving forward. Okay, now on the more broader economic market outlook, I just want to bring your attention to some charts. The first one is that just want to, there are a lot of headlines, a lot of chatters a lot of talks on what Trump means for the market. But if you were to remove ourselves from all of these political dynamics, political noise, eventually, S&P 500 performance track earnings over time, and fourth quarter earnings should remain robust. Earnings momentum should continue, should pick up the pace. That is one of the key tailwind for the broader S&P 500 index. And I believe that we should still maintain exposure to Magnificent Seven stocks. Of course, if you want to manage your risk, you can pare down some of the exposure, put it onto some of the value in light of potential catch up on the end. But I don't think that you should remove yourself completely from the Mag 7 stocks. And the rationale is that if you look at earnings expectations, the Magnificent Seven stocks may continue to dominate. We are looking at earnings growth of more than 17% over the next 4 quarters versus the 9% within the other 493 companies. So earnings growth may continue to tower over the other stocks. And even with all that view that valuation is high, I think that earnings growth should help to offer, that justification for that lofty valuation itself. So, S&P 500 earnings growth, 21.7%. If you remove it, we could be only looking at 9.7%. So, in a way, we still want to be exposed to these high growth, defensive, and stable mega cap tech companies in 2025. Okay, some other charts. Leading economic index no longer signal recession. It signals all clear. After months of all the recession talks, no one is talking about it anymore. We could see it come back, but my view, as I shared in my previous webinar, we need a catalyst to trigger that to start the ball rolling on all of these recessionary forces. For now, that trigger is not there yet, and it wouldn't be wise to jump into it and bet on a recession because you wouldn't know when it will happen. It could take 1 year later, no one knows. Until then, if you were to bet against it, this whole 1 year will be very painful for you. I think we have learned that back in early 2024, a lot of people betting on recession. It didn't, play out. So if you didn't switch your view, then, you could potentially be stuck or rather miss out on many of those gains. Okay, of course, some of the periods. So we know that markets will not go one line up. It will not always be a positive day every day or even every month. Some of the seasonally weaker periods that we can just, side eye for any form of a market weakness. One is maybe the later half of the first quarter, late Feb, early March period, based on seasonality. The other one is, the late September, early October. So these are periods seasonally where it tends to be weaker, and we should, or not should, we may expect some form of a retracement, and that's perfectly normal. Markets need some retracement to offer some form of a sentiment reset to start another leg higher. So retracement are perfectly healthy for the markets. And some of the catalysts that could trigger that retracement, of course, we do not know, but some of the catalysts that I see could be, tariff threats, sell the news on earnings, any geopolitical tensions, or any talks of Fed having to turn more hawkish. Those could be catalysts to weaken the markets. But the broader trend, we believe, could still be linked onto the upside. Okay, last slide, I believe, if you were to tune in to Jensen Huang. So for people who don't know who Jensen Huang is, he is the NVIDIA CEO, gaining a lot of traction given the NVIDIA stellar stock performance over the past years. during his speech, he actually laid out a roadmap for AI evolution. So he believed that the phases could be starting off with perception AI, then moving on to generative AI, which is where we are, uh, uh, potentially riding on now. And then we will move to agentic AI, followed by physical AI. So he laid out this roadmap, and no reason to doubt him, no reason to go against this trend as well. And therefore, some of the stocks that we can keep a lookout for. Of course, that deep dive into the individual stock fundamentals, definitely I still need some time. But these are some of the stocks that are sort of related to these areas of AI that we can keep a lookout for. Okay, last but not least, I think just a quick one. We have kind of overrun by a little bit. A quick one, Bank of Japan preview. The last key risk event we have is this Friday, Bank of Japan interest rate decision. If you follow the news, I think 25 basis point rate hike has been largely priced. But if we look beyond that headlines, we also know that there are some expectations that it could be a one and done, meaning the Bank of Japan may hike by 25 basis point, yes, but they will lay out a guidance that they will keep rates on hold. They do not foresee further increase, for example. So something to keep a lookout for, given that if you were to remember in August 2024, when the Bank of Japan hiked rates, that there was a strong market sell-off, not just in the Nikkei, but across global markets. So will markets react that same way in the event of a rate hikes? Definitely very key to keep a lookout for. But what we believe is that any form of a rate hike, we believe they may deliver that 25 basis point. So we may initially see a move lower in global markets. We may see the yen strengthen, but thereafter, we may expect them to come in during the press conference and say, coming up with a more dovish tone just to mitigate some of the yen volatility. So be careful of any initial move. That statement, that policy statement, and that press conference, we could be seeing different tonality coming out from there. So just be careful of any initial move. You can jump on it, but those should offer short-term trade opportunities. I think the policy guidance should be that greater tailwind for that movement in the yen and the Nikkei over the medium term. So justification, I think rising inflation, broadening wage hikes, that should justify the Bank of Japan to hike rates. Previously, Japanese policymakers, they're kind of fearful that, Trump coming onto the top seat, there should be some volatility. So they are more wary on they are more wary on committing to a rate hike straight away. But first 2 days of Trump inauguration, the markets hasn't been so volatile as what has been feared. Markets really holding up. That should offer some conviction for Japanese policymakers to move on with rate hike. So some of the chart that we are watching, dollar yen, some support confluence, 154.5, 154.4, sorry. If you were to see any breakdown of that, that should pave the way for further downside. But the broader upward trend, that seems to be intact. So we are trading this broad rising channel. Of course, with eyes on what the Bank of Japan will guide for. Nikkei, some strong performance today riding on SoftBank. That SoftBank is directly involved in that private sector AI infrastructure spending that Trump has, announced overnight. 500 million, SoftBank is part of it. Oracle is part of it. That explains the jump in the SoftBank share price today, giving that uplift for the Nikkei. For the Nikkei, I think we can draw this a rectangle sort of pattern, a month long range in place. And when we look at a month-long consolidation or months-long consolidation, what this means is that any form of a breakdown will potentially be amplified. Because when we look at consolidation, it means that the longer it consolidate, okay, the longer it consolidate, it means that the build up in terms of supply and demand is stronger. You know, that changing of hands activities are more prominent, given that, you know, time, that long dragging time that it has for it to play out. So now it has been consolidating for months, since October 2024 all the way till now, this broad ranging range. What this means is that any form of a breakdown should trigger a lot of reaction. So this will be something that we'll be keeping an eye on. But for now, based on this, it does seems like, you know, potentially some upside towards that upper consolidation range around that 39,630 level. And then if you want to go for a short-term trade, you know, just be careful that we may expect some form of a resistance there. Okay, so that's the end of today's webinar. So I hope it does give you a broad overview of the markets, along with some of my views on you know, what's ahead of us. If you have any questions, do feel free to type in the question tab. Yes. Okay, one of it is Magnificent 7 ETM. Mac holding consists of swap. What is the benefit of and risk of this swap? Sorry, I'm not a swap person. Sorry about that. You know, I trade the CFD, I trade stocks. So I'm not too sure on that. Yeah, so sorry about that. In my AI slide, was it good or GOOG? Give me a moment. Let me just rewind back. Okay. Yeah. Sorry. I think this should be Google. GOOG. Yeah. It's not good. It should be GOOG. Yeah. Okay. How about silver? So I actually wrote a piece about silver. And we need to understand that silver tends to track gold prices. So if you look at silver prices in 2024, gold has run up more than 30%, and silver has also run up more than 30%, even though central bank demand hasn't been too prominent for silver as compared to gold itself. So with a bullish outlook on gold, I think it's naturally that we should have a bullish outlook on silver as well. And in my piece on silver, you know, I'm looking at some of the money positioning in silver. It is not too overblown. It's more neutral in that sense. And what this means is that there's still room, you know, for sentiments to improve and for some catch-up performance for silver. So generally, you know, I believe that silver should also see some form of a upside. Okay, next question is your view on defensive stocks, consumer defensive. I would say if you are looking at consumer defensive, it should only be an addition as a hedge against volatility in your portfolio. Given that if you are taking on a more risk-on approach, it means that defensive should lag the broader markets. So, you know, so there's a question of whether you want to be exposed to that. So the only reason I believe is that it is an addition to bring down volatility in your portfolio. But when you talk about defensive, you know, I mentioned that probably utilities, to me, that sounds like a sort of a better options. I think moving forward, utilities give you that defensive status, but at the same time, it has that exposure to that AI energy demand trend, which we foresee, you know, energy demand should continue to improve over the coming months. That could offer that form of a tailwind for our utility prices. Utility, I believe the only risk or the risk could come from the regulatory side of things. You know, when demand for energy is high, uh, regulations tends to kick in. But that is something that is unavoidable. That is something that we got to keep a lookout for. But you know, when regulations kick in, it also means that you know prices are also offer a tailwind for some of the utilities stocks. Okay, where can I find information or learn about these types of chart? What chart to compare? Which chart to look out for? No clear answer. I think generally I use TradingView to find out some of the correlations between certain asset class to compare, to do my relative comparison, you know, such as how utilities is performing with S&P 500. I think TradingView offer that kind of a good function. Probably the question is what factors you look out for, which I believe should differ across different investors or individuals. Yeah, so what I'm sharing with you is purely, you know, how I look at certain sectors or markets. I think generally other investors will have their own approach or their own view with that. Yeah. Since the upside of US is broadening to other sectors, will Magnificent Seven and technology still lead in the upside? Okay, that's a very good question. Yes, we do see the broadening of earnings momentum towards other sectors. So what this means is that, you know, almost all of the S&P 500 sectors are projected to deliver positive earnings growth this year. That is significant. It is an improvement from last year. And my view is that yes, we could potentially shift some capital towards some of the laggards sectors, for example, but I will still want sort of my foot in the Magnificent Seven, in technology, in communication services, largely because, you know, just now I shared these slides where they are still the companies that are expected to deliver the highest earnings growth out of, you know, the other sectors itself. So for example, you know, we could be looking at if we remove the Magnificent Seven stocks from the S&P 500, the earnings projection is around 9.7% for 2025. But if we include the Magnificent Seven stocks in the S&P 500, the earnings growth is 21.7%. So what this means is that there may be improvement in earnings growth for the other sectors, but the one that pull ahead, the one that could have that heavyweight tailwind for the broader index is still that Mag 7. So I think we can pad out our exposure, yes, but I believe we should still remain exposed to these mega cap tech counters. Okay, some question, McDonald's, Pepsi, Coke. I haven't taken a look at their chart, so probably, you know, maybe I will present on them next week. Platinum hasn't been taking a look at that as well. I think recently has just been all about oil and gold, but yeah, I may put it down for next week. Okay, the tariff cut, while uncertain, has a bearing. What's your view on Trump positioning? Yes, generally when we talk about Trump, he is very unpredictable. Whatever he say, whatever is being followed through, there could be a disparity. So it will be a market that is very headlines driven, a lot of volatility. But if we, you know, as I mentioned, if we just take a step back and try to look beyond all of this political noise, I think what his policy brings should see relatively more traction for the US markets. So he is very pro-US. He wants to bring investment in. And the reason he's imposing tariff on other countries is such that, you know, he can follow through with some of the tax cuts that he promises. He wants to fill the gap in terms of the government deficit spending through tariff. So what this means is that the pressure will be on US trading partners. Therefore, if you ask me, Trump 2.0, Trump positioning, I will still want to lean towards Trump itself, which is the US market. The other markets, we do not know how much tariff. There's a lot of uncertainty around there. It's very subjected to what Trump says. So I will suggest, having minimal exposure in that sense until we see the worst of what Trump brings. So lesson drawn from 2018 trade war, when he first imposed aggressively a lot of tariff, we are seeing a sell-off across Asian markets. Thereafter, once there's some form of negotiation, the investors believe that probably the worst has been priced in, then we see that recovery. So I think kind of uncertain, I think things could still sort of get worse before it gets better in the second half. So that's something that we can take a look out for. These defensive do well in inflationary times. Okay, I believe you are looking at that previous question on McDonald's, Pepsi, Coke. Do they do well in terms of inflationary times? I got to go back and track on that. I'm not sure whether they actually do well in inflationary times. I got to see more data to back that. Yeah. Military sector in 2025. Yes, I think military sectors has seen some run up for some of the military stocks. I think US, yes, but I think the greater catch for military stocks should be at the Eurozone. Rationale is because Trump wants to pressure the EU to raise their defense budget from 2% to 5% of their GDP. So what this means is that if EU wants to have some form of negotiation, wants to avoid or want to keep Trump happy, they will follow that. What this means is that there's increased defense budget, which should flow into some of the European military stocks. View on SG. I think view on SG is that I know it has run up quite a bit, but of course near term, a lot of uncertainty around Trump's tariff. So you can see that the STI has been consolidating lately, really trading in the range. There's sort of a tone of caution that I see because Trump bringing up tariff on Canada, Mexico, China in the crosshair as well, and China will have a more direct impact on Singapore, given that we do sort of re-export some of the Chinese goods. So China is our largest trading partner. Economic pressure on China's end will not bode well for us as well. So I may expect a tone of caution to persist as we lead up to that 1st February deadline that Trump has mentioned. So I believe that we may see some form of a profit taking in the near term for the STI. Okay, let's see. Max 7, if you were to choose 3 out of the 7 stocks to invest, I will lean towards Meta. Valuation play, earnings growth play, I will lean into Alphabet. Last but not least, I will lean into Amazon. So I think Amazon potentially the upside. The earnings growth, seems more rosy in the upcoming quarter itself. So of course, I will choose Nvidia as well. I think if you believe in the AI team, you will want your exposure to Nvidia. I mean, that is the key star for that AI team. So Nvidia as well. Okay, so with that, I think I come to the end of my presentation. It's near 8 p.m. So next week, we will reconvene again and look at what's happening in the markets. Oh, sorry, next week is actually Chinese New Year. Yeah, so next week there won't be any webinar. We'll reconvene again once Chinese New Year ends. And with that, thank you so much for attending today's session. I hope that you have something to learn from the sharing. I've also managed to learn from some of your questions, and I will keep a lookout. I will resume that webinar in the early February. And until then, I just want to wish everyone a happy Chinese New Year in advance, and hope that 2025 will be a good year for all of you. So with that, thank you and goodbye.